is the Royal Financial Investment Group. My name is Prince Dykes. Coming to you guys live today. Decided to bring it back to the office a little bit to have a conversation so I wouldn't have a problem with winds and you having the ability to not be able to hear me and stuff like that. But let's jump straight into the topic. Options trading 101. Option trading for beginners 101. Lesson 2. So if you haven't seen lesson 1, go to the description box below and I will advise you to go see lesson 1. You're going to see some great things there. But before we jump straight into the topic, as always, don't forget to hit the like button, subscribe button, comment button, share with your friends. Give me a thumbs up if you think I'm doing a good job. Give me a thumbs down if you think I suck. But if you're going to tell me I suck, leave comments below. Let me know how I can get better. I want to get better. I want to be the best. So let me know how I can get better. Also, if you have any questions, issues, or concerns, the quickest and best way to get in contact with me is dropping a comment below. But let's get straight into the topic. So options trading for beginners, lesson 2. So in lesson 1, what did we learn? Lesson 1 built the foundation. It set the foundation up to where if you didn't know anything about options trading, you got a pretty good idea now. You kind of like, okay, I got a little bit of understanding of something like that, but let's take it a step further. Now, in lesson 1, we discussed that what a derivative was. We used the example of the company giving away a car, and as that car gained value, so did those raffle tickets. So you say, okay, I understand that. Let's take it to the next level. Now that car, we're going to replace that with a particular stock. Right? Let's say we're going to use the stock, for example, Apple. We're going to use the stock Apple. So as the stock Apple gains value, so does the contracts. You're like, okay, I understand that. So if you go in and you purchase a contract, what are you purchasing? So let's take it a step further. What are you purchasing? Let's see how it all works. So you all know that when we buy a stock, buy a particular stock in one company is very risky. Why is it very risky? Because that company can very well go out of business. Radio Shack, Blockbuster. You know, there's plenty of companies that we thought would be great and amazing, but they're going out of business. What happens when those companies go out of business? What happens to the stock? It goes down, right? So let's say you took your whole life fortune and you was to put it into Walmart. And 10 years from now, Walmart bellies up, goes broke, files bankruptcy. Things happen in business, right? Now what would happen to your particular stock? You run the risk of losing all of your money. So that brings us to the topic of hedging. So a hedging is considered, let's go back to that example of somebody who bought a bunch of stock in Walmart. And they say, well, I have all the stock in Walmart, but what happens if the stock just, bellies up and goes bad? So that's when they become a buy writer. What they do is they write contracts. They write contracts that says, hey, I will give you the ability to be able to buy my stock for this price at this particular date. Right? So someone who owns 100 shares, you must at least own 100 shares. And lesson 1, we learned that 100 shares equals one stock. 100 shares equals one stock. So if I have 100 shares of Walmart and I want to, let's say, I want to hedge myself, means protect myself just in case this company bellies up. How can I do that? Then I can become what we consider a buy writer. When I write out a contract to another person, I go in and I say, hey, I will sell you 100 of my Walmart shares for $50. You can buy my stock for $50. You can buy 100 of my shares for $50 for this, all the way until this time in the future. Now, when I say, hey, you can buy my shares for this price, that price is considered the strike price. When I say, hey, you can buy it all the way until October 1st, that date that we come up with, the expiration date. So someone else will come in, they will say, I like that contract. So when you go in and you purchase a contract, you are buying the right or the option to be able to buy or sell a particular stock at a desired price in the future. You follow me? So when you go in and you buy a particular stock, you're buying from somebody. You guys come to an agreement. A person will say, hey, you can buy my stock for $50 by this date. You say, okay, cool. I can do that. I'll purchase it from you. And what you pay that person in exchange is called premium. So let's take it back to the beginning. I own 100 shares in Walmart. Maybe I may say, hey, I want to protect myself or hedge. Hedge means protect yourself. What if the stock goes down? I want to protect myself. How can I protect myself? I write out contracts, right? Maybe make a call or put, depending on your strategy, I write out a contract saying, hey, I want to be able to sell my stock at this price all the way until this time in the future. And for this contract, I'm going to charge you $200. So when you go into your options chain, you see these prices. These are the prices you're seeing. You are buying, you're not buying a stock. You're just buying the option to be able to purchase or sell this stock in the future at a particular price. That is all you're doing. That's what you're paying your premium. That premium, when you pay that money, that goes to the person who owns the stock. Now you have the option. Either you can buy those stocks or sell those stocks for that price in the future, or you can just take that contract, sell it to someone else, or you can just do nothing with it and let it expire worthless. It's all up to you. Now, we're going to take that metaphor that we discussed in lesson 1, and we're going to tie it into this one, right? So you can see, you say, okay, I understand. Prince, when I go in and I buy that stock, it says, when I buy the contract, it gives me the right to be able to, I don't own the stock, but it gives me the right to be able to do something. Remember that in lesson 1, we discussed the person that bought the raffle ticket. The raffle ticket person did not control the car. The car went up, it started a Honda Accord, then it went to a Lexus, then it went to a Jaguar. The person who owns the raffle ticket, they have no control over if that car value fluctuates or if it depreciates. If it goes up in value or if it goes down, they don't have any control over that. All they have is the possibility to be able to win the car in the future. So when you go in and you buy that contract, all you're doing is saying, hey, I have the right to be able to buy this car in the future. Now, if Walmart stock gains value, you can say, hey, does anybody else want this contract? You can sell it to someone else and make a profit. You follow me? Just like the person did in the raffle tickets. The person in the raffle tickets, remember they bought the ticket for $100, then it went up to $200. They didn't control anything. It's just the value of the underlying, that's what they call it, the underlying asset, which was the car in that situation, which is the Walmart stock in this situation. As that value gained, guess what? So did that ticket value gain. The person bought it for $100, they sold it for $200. For this example, in real life, you buy a contract, you pay the premium is considered the price you pay, and then if that asset gains value or loses value, depending if you bought a put or a call, that contract gains value. So you may purchase it for $200, then as that Walmart stock starts to rise, someone else may say, wow, I'll buy that contract from you for $400. And that's how it happens. And that's when this person doesn't own the stock anything. They bought a contract, the price of it went up, they sold it to someone else, and they're out. That's how you can make money off of just buying contracts and selling them to someone else, or even owning the stock. Also, I use in there where I use a game of craps, or people that roll dice and stuff like that. I use situational place side bets. Someone places a side bet, hey, I think he's going to win, I think he's going to hit, I don't think he's going to hit. They don't control anything. They just trade on the side. So I'm tying that into real life. Now, I'm going to conclude lesson 2. Now that we understand what a call is, we understand what a put is, we understand expiration date, we understand what a buy rider is, we understand what hedging is, and now we understand how it all kind of ties into each other when you're looking at this, when you hear this crazy thing called option trading. You're like, man, what in the heck am I buying? Or what in the heck are they talking about? A call? How do you make money off of that? So now, hopefully you have a better understanding. Now, lesson 3, you got to watch lesson 3. And lesson 3, I'm going to start walking you through these things and show you in detail. We're going to tie everything in together, and we're going to actually do walkthroughs. Right? So that's it for lesson 2. Thank you guys for watching. Don't forget to like, subscribe, comment, all of the good stuff. I did record this video earlier at the beach, but I was having some microphone issues. There's a little too much wind, and I didn't want to run the risk of you guys losing all the value. So I decided, hey, you know what? I'll stretch it. I'll just come back into my office and just do it that way so I can make sure everybody got the information. As always, thank you guys for watching. Until the next video, be safe.